In this video, I'm talking about how you can make better timing decisions using the volatility index. Now, this is covering the Australian equity market, and this is going to help you whether you want to buy shares or sell them. Now, I know traders who use this a lot, and it's very beneficial for investors who are looking for the time on when to get in. Now, this looks at the market as a whole rather than individual stocks. But because a large percentage of the securities within the market trade with the index, it's often a good sign that when the index is down or up, the underlying stocks are going to trade in a very similar fashion. So with that said, let's get into an example to help you understand. At the moment, the ASX 200 index trades at 6,335 points. The volatility index is about 11.5, which means that the institutional traders, and I'm talking about market makers here, are pricing that the ASX 200 will trade within a range of 6,545 down to 6,125. So you can have a look at this chart and see what I mean. Now, it's a range of 3.3% higher and 3.3% lower. So over the next 30 days, what they're saying is that the Australian stock market will trade within a range of 6.6%, 68% of the time. Now, if you want to increase that probability, you essentially just say that the market will trade within a higher range. So what I mean by that is if you want a 95% probability that over the next 30 days the market will trade within a specific range, at the moment, based on the current volatilities levels and where the market's trading, institutional traders are essentially saying that the market could move up 6.75%, up to 6,763 points, or down to 5,907 points. And I've got this marked here by two different boxes on the table here. Now, the first one, the blue box, represents the 68%, and then the orange box represents the 95% probability. Now, I don't want to go into the hardcore statistics of how and why this works, but it's really important to remember that the volatility index is a measure of fear. And by using it, you can work out whether the market is going to make a large move over the next 30 days or a small move. Typically, when the equity markets are rallying, you'll see a decline in the VIX, and you'll also see that the market is trading within a very narrow range, even though day by day it would be rallying. Now, the important takeaway here is that if you're looking to get in on a pullback, you've got to decide which level you're going to get in at. And I want to give you an example. Let's say I'm thinking about making an additional purchase into the stock market. It doesn't matter whether I'm buying a portfolio of 15 securities. I'm looking to put some money to work. Now, at the moment, the index is trading at the 6,335 level, and I'm thinking to myself, well, if it gets down to 6,150, I think that's a pretty good place to get in. At the same time, if I'm thinking to myself, well, do I want to stretch it? Do I want to get in at 6,100? Now, the reason this is important is that when you purchase securities, and you can always refer to my video about dollar cost averaging, when you purchase securities over time, you're going to get an average price of those. But when it comes to timing individual parcels, you want to typically set a level and then get into the market at that price point, because it helps take out some of the emotion and the fear that often comes along with purchasing or selling shares. Now, I think it's really important here is these volatility levels, when they get really low, so under 10, are typically indications that the Australian equity market is getting pretty complacent. And what I mean by that is that investors are willing to buy riskier securities that are yielding a lower return, and I'm talking not only about dividends and franking credits, but also the expected growth in those securities, what they're essentially saying is that everything's okay, I'm willing to take more risk, I'm bidding the market up, and it can potentially be a sign that volatility is low. If it's low, then it could spike higher, which means you're going to get a pullback, which means if you already have your portfolio invested, you're going to have some losses. These are mark-to-market losses. But if you're looking to get into the market, it's an opportunity to buy. So with that said, thank you very much. Until next time, please subscribe and have a great day.